Hi, I'm Pattu from freefincal, and in this video let's talk about if we should invest in MNC funds or mutual funds that invest predominantly in multinational company stocks, and we'll also compare UTI MNC Fund and ABSL or Birla MNC Fund. So currently there are three MNC themed mutual funds, or they are called thematic mutual funds. The Birla Fund was launched in April '94, has an AUM of about 3,400 crores, expense ratio of 1.2% for the direct plan. The UTI MNC Fund launched in July '98, AUM of about 2,000 crores and expense ratio of 1.43%. The SBI Magnum Global Fund became an MNC fund only in May 2018. Before that, it was a mid-small capish kind of fund. It has got an AUM of about 3,486 crores. We'll not worry about SBI Magnum Global Fund because it's a recent fund. Now, before we get on, it's important to understand that thematic funds have got peculiar concentration risks. Now, although MNC funds have got a good history of governance and return on equity, and generally they are less volatile than the index, that is Sensex or Nifty, there are special situations like sanctions or wars that can affect only certain types of stocks, any kind of thematic stocks, and including MNC funds. So before you take a big exposure to MNC funds, you must be aware of this risk. If you take a small exposure, then like we talked about yesterday, it doesn't make a difference in a good or bad way. So there's no point in taking a small exposure. So an MNC stock is one where the company has major shareholding by a foreign entity or the Indian company, or it should be an Indian company having 50% over 50% turnover from regions outside India, or it should be a foreign listed company. Thematic MNC funds will invest in 80% of the portfolio in such stocks. Typically, if you take a diversified mutual fund, they will not have much or any MNC stock in their portfolio. There is a Nifty MNC index. There is also a Sensex MNC index. You can look at the link in the description box to understand how the stocks are shortlisted. These are the current top 10 stocks, and you can have a look at by pausing the screen. And if you compare the Nifty 50 or the Nifty versus the Nifty MNC over every possible 5-year periods, that's in the top panel here, notice that the MNC index has generally outperformed the Nifty. And in the bottom panel, you have the rolling risk or the volatility measure. So we are looking at fluctuations in monthly returns for every possible 5-year periods, and higher the line, higher the volatility. So the Nifty MNC index has been more or less comparable to Nifty 50, or has been a touch lower. So by investing in the Nifty MNC index, you tend to get this is a 15 stock index compared to Nifty 50. So by investing in the MNC index, you generally tend to get volatility comparable or a bit lower than the Nifty 50 or large cap like, and the returns are a bit higher. So again, the scenario is the same for over 3-year periods. Comparable volatility, just a touch more returns. And now we add the green line. The green line is the UTI MNC fund, the red line is Nifty 50, and the white line is the Nifty MNC index. The UTI fund has done reasonably well over 3 years, but since September 2017, it has the performance has rapidly fallen below the MNC index and also become comparable to the Nifty 50. So that's a problem. So you may have to go through such periods of outperformance. But in terms of volatility, it's lower than both the indices. And this is over 5 years, and over 5 years it has done okay in the past, but since September 2017, it's comparable to the Nifty MNC index, but the volatility is a bit lower. And this is 5-year data for the Birla Fund. Now red is Nifty 50, white is the Birla Fund, and the Nifty MNC is the blue. And you can see that the Birla Fund has a slightly better record than the UTI MNC Fund in terms of beating both the Nifty 50 as well as the Nifty MNC index, and the volatility is comparable to Nifty 50. And if you compare the two together over 5 years, you can see that the Birla Fund has got a little bit higher returns, and the volatility is also a little bit more than the UTI MNC. So the UTI is in green and the Birla Fund is in red now. So the red line is just a little bit higher in terms of returns, and the risk is also a little bit higher. Sandeep Nangrani pointed out in Facebook group Asana Days of Wealth that this is because the Birla Fund has got a mid cap bias, whereas the UTI Fund has got a large cap bias. So if you want to play it safer, you may use the UTI MNC Fund. But if you're a bit more adventurous, you can choose the Birla Fund. But if you compare return to return and risk to risk, you get a bit more return in the Birla Fund for a bit more risk. And I think that's a reasonable bargain. So finally, should you invest in MNC funds? Now you have three choices as I see it. One, you can buy MNC stocks and not the funds. You can simply choose MNC stocks that are part of both the Nifty MNC index and the Nifty low volatility 30 or the low volatility 50 index, or you can choose the stocks from the Nifty 100 screener. The link is in the description box. Or you can buy the Nifty MNC funds instead of large caps, because you get comparable volatility to large caps, at least with the US UTI fund. You get a comparable to Nifty 50 volatility and the return is a bit higher. So you can replace the large caps with the MNC funds, but that's very risky because there is a thematic risk. Or you can stay away from MNC funds and stick to diversified funds. So my suggestion is that you can, if you are interested in buying stocks directly, buy MNC stocks by evaluating them directly, and do not use MNC funds. You can consider replacing MNC funds instead of large caps, but you must be aware of the thematic risks. Otherwise, if you don't want both the paths, stick to good old diversified funds and you should be okay. So that's what I wanted to say in this video. Thank you as always for watching. I'll catch you again later. Bye bye.